The key is to make sure that you're actually earning enough to cover any sort of negatives with that property, and also making sure that if it is negatively geared, that you can effectively afford it. Very similar to like George said, you've got a couple, no kids, fantastic, heaps of money, they just bought themselves a nice little Porsche and all that, life's great. 1 or 2 kids later, their income halves. Can they really afford those investment properties? Should they be getting into it now? Those types of things. So have a look at your personal cash flow before you start investing into it. Speak to your accountant to just see what type of impact it will have on your life and whether or not it's worth jumping into it. The next one is, this is a very important one, which is making sure you've got a reserve fund of cash. So one of the things I do say to my clients is, once I work out roughly what the cost will be for the property, is say, well, okay, let's just say you can't get a tenant for 6 months or even 12 months. Let's do the assumption that something happens to the property and you've got to fix something that's not covered by insurance, which is $40,000 or $50,000. Do you have the funds available? Do you have that buffer when you go invest into these investment properties? Just because you got the deposit may not be enough. You really should have that little bit of buffer, a little bit of extra funds available. Again, speak to your accountant. They'll work out with you in regards to what's the best options there.